Hey traders, and welcome back to Mindfully Trading, where we empower individuals to make informed decisions in the world of trading. In today's video, we will explore the key differences between Forex trading and stock trading. So whether you're new to trading or you're considering expanding your investment portfolio, understanding these differences will help you to make decisions that align with your goals and your preferences. I have been trading for about 5 years now, and I am currently day trading pound against the dollar, so I focus purely on day trading the Forex market. I trade this in both my personal live account and also with a prop firm, the 5%ers. If you don't know what a prop firm is, this is basically where you trade with a company and you take a split of profits that are made on the account. So I've actually been working with the 5%ers for some time now, but recently I've undergone their high stakes challenge, and this is where I am trading their account size of $100,000. I have to respect the rules, so there is a 10% max drawdown on the account. I can't hit that, otherwise I blow up the account. But if I can manage my risk effectively and respect the rules as I have done so far, any profits that are made on the account, we take a split of. So it's 80% to the trader, for myself, and 20% for the 5%ers. Now this does change as they do scale up as you make more money on the account, and trading with a prop firm in this way is a great option if you are a trader who struggles with lack of capital. This might be a little bit more advanced for you if you are right at the beginning of your trading journey, if you're just learning the basics. But it is great for you to see that if you do struggle with lack of capital, if you don't have a lot of money to invest in this industry, you don't actually need it, because when you are ready, you can undertake a challenge with a prop firm like the 5%ers. And if you are successful, you could trade a higher capital size as well. So I have got a link in the description below for more information on that if you're interested. So let's dive right in. Starting with our first point, and that is market accessibility. Forex trading and stock trading differ in terms of market accessibility. What does that mean? Well, Forex, also known as the foreign exchange market, is a global market. It is where currencies from all around the world are traded and exchanged. I'm talking about all sorts of currencies, ones that you may have heard of, such as the Great British Pound, the US dollar, the Canadian dollar, the euro, and some of the more lesser known currencies as well. The Forex market operates 24 hours a day, 5 days a week. It is closed at weekends. But this allows for very flexible trading hours no matter where you are in the world and no matter what time you are available to actually trade or invest. On the other hand, stock trading involves the buying and selling of shares of publicly traded companies. And this is typically done through stock exchanges who operate with specific trading hours. So this may depend upon where the stock exchange is based, such as the New York Stock Exchange will operate during New York hours, or the London Stock Exchange will operate during hours based in London, UK. But let's have a look at market liquidity. Liquidity refers to the ease of buying and selling an asset without significant price impact. Forex is the most liquid traded asset in the world, with trillions of dollars traded every single day. This high liquidity ensures tight spreads and minimal slippage. Whereas stock markets, whilst they are generally liquid, they may have varying types of liquidity depending on the type of stock that is being traded and also the market conditions. So this may mean that you will get a wider spread for certain companies, for certain stocks, or you may experience slippage for certain companies or certain stocks. Now, as I mentioned earlier, the Forex market is open 24 hours a day, 5 days a week, meaning that it is available to trade any point during the week, except for weekends when it is closed. It provides ample trading opportunities for traders who are in different time zones. Stock markets, however, have fixed trading hours sessions, and they're typically aligned with the local business hours of where that stock exchange is located. Now let's talk about the instrument variety between trading the Forex market against the stock market. Forex trading primarily involves trading currency pairs, allowing traders to speculate on the exchange rate fluctuations between two different currencies, such as the euro against the dollar. In contrast, stock trading can apply to a wide range of assets. This can include ETFs, exchange-traded funds, stocks, options, and futures. This variety gives stock traders the opportunity to really diversify their portfolio across different industries and different sectors. Now, going back to market volatility, as we know, Forex is well known for its high volatility, which presents frequent trading opportunities. Currency pairs can experience significant fluctuations due to different factors such as economic events, geopolitical events, and also central bank decisions. Stock markets, on the other hand, whilst being subject to volatility, operate slightly differently, and they depend on different factors. So this may be more business related to news that has been released about specific companies, industry trends, and also broader market conditions. Now let's look at fundamental analysis and how that varies between Forex and stocks. And if you're not familiar with the term fundamental analysis, this is where you are analysing an asset based on the fundamentals. So this can be based on news, based on company-specific data, or country-specific data. Both Forex and stocks involve fundamental analysis, which assesses the intrinsic value of an asset based on economical, financial, and industry-specific data. However, Forex traders mainly focus on macroeconomic indicators, and this basically means focusing on geopolitical events and central bank policies that may impact a currency's fluctuations. On the other hand, stock traders will analyze company-specific statements, financial statements, earning reports, and industry trends to evaluate the performance of that business and of that stock. Moving on from fundamental analysis, let's look at technical analysis. Then this is basically analyzing the possible movement of an asset based purely on the technicals, usually in the form of a price chart. And both Forex and stocks involve technical analysis. Traders will analyze price charts, they will look at candlestick patterns, and they may also look at indicators to try to help influence their decision on whether they think an asset's going to go up or going to go down. It will help them to identify possible trends, possible resistance, support, key levels, and possible entry points. Whilst the principles of technical analysis does apply to both the Forex market and also the stock market, the Forex market may focus on the more faster time frame technical analysis due to the high volatility that's present in the Forex market. Whereas stock traders may utilize longer time frames. So for example, a Forex trader may focus purely on intraday price action, looking at faster time frames such as the daily, the 4-hour, the 1-hour, the 15 minutes, maybe even the 5-minute time frame. Stock traders, on the other hand, may favor the larger time frames, and it may apply better for swing traders who are looking to hold positions for a little bit longer. Now let's look at some more broker-specific data in this comparison, looking at leverage and margin. Forex trading offers the opportunity to trade on leverage, meaning that traders can control a larger position size with a smaller amount of upfront capital. It's where the broker will basically lend them some money, some buying power, so that they can purchase a larger position for their trades. However, this increased leverage also comes with an increased risk, as losses can also be magnified, and you have to take this into account with your overall account size and what you are comfortable risking and losing. Typically, stock trading doesn't offer as much leverage as Forex trading, with margin requirements varying depending on your broker and also the country that you are in. For example, when I day traded stocks, I had a good leverage, and that was at 6-1. Since I have moved to trading Forex, my leverage is now at 100-1. So there's a massive difference there, which can be good but also bad because you need to manage the risks involved. But let's talk about something that can often be overlooked, and that is the regulatory environment. Both Forex and stocks are subject to regulatory oversight to ensure fair and transparent markets. However, the specific regulation and governing bodies may differ between the Forex markets and the stock markets. This is why it's critical for traders to choose reputable brokers and exchanges that adhere to standards to protect their interests. So there are different financial regulation bodies all over the world. For example, if you are going to trade Forex, if you like me, you're here based in the UK, you can choose a broker that is regulated by the Financial Conduct Authority. So you know that your broker, your funds are going to be protected because they are regulated by a recognized body. And our final comparison between Forex trading and stock trading comes down to personal preference and goals. Ultimately, the decision between trading Forex or trading stocks comes down to your own personal preference, trading style, and goals. Consider the different factors that we have brought up in this video: the market accessibility, when you are available to trade where you are in the world, instrument variety, liquidity, how you like to trade. Do you prefer faster markets? Do you prefer slower markets? And your comfort when it comes to volatility and also leverage. Do you prefer more conservative trading, or do you prefer to take a little bit more risk? Align your choice with your financial objectives, with your risk management preferences, and also the amount of time that you can dedicate to trading. If you can make a clear plan of what you are comfortable with, what aligns with your goals, then it will help you to pinpoint which market is probably better suited for you. But overall, Forex trading and trading the stock market offer significant opportunities and also challenges for beginners. By understanding the differences that we've discussed in this video, you can make informed decisions that suit your individual needs. Remember, whichever path you choose, education, practice, and risk management are key factors to success on the path of trading. If you are looking for any further resources when it comes to trading, I have included some links below in the description to my recommended broker and to some software, charting software, and different things that I found useful over the years, so do check them out, as well as other videos on my channel that may help you out. Make sure that you're subscribed below, and if you've enjoyed this video, please let me know by hitting that like button, and I'll catch you in my next video. Thanks for watching. Bye.